Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, February 17th, 2026. It is 12:26 p.m. Eastern Time as I'm starting the video, so we're about halfway through the trading day. Just want to kind of do a quick one, show you some of the things I'm watching, some developments that have already occurred, and more importantly, some potential developments to watch for. All right, so this is QQQ, nothing new unless you're brand new to the site. I've been talking about this trading range forever and a day. It is getting extremely long in the tooth. That's this box right here. Let me try to put up my box tool with the screen drawing software here. Bear with me. That would be a frame tool. There we go. So kind of moving sideways. The key support is the bottom of that range, that level here at right about 589. You also have the key 200-day moving averages just below it. Nothing has changed in my outlook or my analysis of the charts. Again, anything can happen, but I still expect expected a failure there at the most recent high or marginal new high, still divergent high, and then come on down to we were there just a couple weeks ago, talked about next stop. It's typically the midpoint of the range, and then once you take that out, down to the bottom. We already hit the bottom of the range. Remember, I got that chart out to you in pre-market. We were exactly at that level. This only shows regular session trades. So we hit, bounced, had a little hurrah. One last chance, again, what I suspect will probably be that one last hurrah. And then you can see how well, I keep talking about this midpoint line, how that delineates the little micro trends within there once you go down below it. We had a whipsaw there, but it was a stick save printed right back on there. But so we hit the bottom of the range, bounced up to the top of the range, which was also that 50-day moving average. If you look at the yellow line right there, which also helps to find the shorter term trend. And that's it. So 589 remains support. I suspect it'll be broken. That's still my preferred scenario. But as I like to say and very often do, support is support unless broken. So that's the reality of what we have, guys. A multi-month trading range. It's been a stock picker's market, that's for sure. Short-term trading ops exist. If you want to trade the indexes, you just have to go down to the intraday charts. Or again, you can swing it off the daily charts, but basically you want to be closing out longs and or initiating shorts at the top of the range. And again, as I said, you can also trade off that midpoint range as well. So, the bounce up to there and there. So that's it. That's bigger picture stuff. I'm going to go to the monthly just to show you, this is the QQQ going all the way back since that ETF was the inception of it back in the late 80s there, early, about 1990, right about the start of the 90s. And this is what it looks like. But what I wanted to show you here, this PPO histogram does a great job. That is the histogram is just the difference or differential between the PPO line I have in blue and the signal line in white. And so when they cross, that's when you're going to cross the zero line here on the histogram, when these two lines cross. And again, I've talked about this one over the years many times. It's a great trend indicator and can kind of give you an early heads up on when a trend changes. So I'm just scrolling back, going back into the 90s, and we're talking .com right here, .com bubble. And then boom, right after the market peaked, that trend indicator flipped. And that box, the purple box, just shows you throughout that about 80% drop. The histogram was red, saying the primary trend was bearish. And then all along, we've had nice corrections in bear markets since. We had the 18% drop. So without fail, as each and everyone shows you right there, you can see the histogram when it's red. We've had these corrections ranging from, they're all double digits into the into the mid double digits, 55% in the financial crisis back in late 07 to early 09. 16, 13, 26, 24, 31, 38, 25. That's the last time we had it. And now here's what I wanted to cover, because we're there. The month is not young anymore. We're on the 17th. Remember, February is a short month to begin with. So I'll be watching this. Again, when you look at this, even COVID, if you blinked, you missed COVID, but it was a 31% drop in the NASDAQ high to low. And so that was far from a whipsaw, that told you. Again, it's associated with that bear market when COVID hit. So zero whipsaws as I go through here. And now, again, it's a monthly chart, so all that matters is how we close the month. So I will certainly be following up on that after February wraps up. It also works just as well in the S&P 500. You can see we can roll back here. SPY, one of the first ETFs, came back out in the late 80s there, like 1988. And the histogram just started to populate here, so I'll click over there. But again, same story, guys. It's pretty simple stuff. Bear markets, corrections, 23%, 51, 57. There's a financial crisis. This was the dot-com bubble burst. SPY took it a lot better. The Qs, the NASDAQ 100 took it on the chin because it was chock full of tech stocks, the semis. Same thing when the AI bubble implodes, you can expect, unless something bad happens to the banking system, most likely the NASDAQ 100 will fall more than the S&P 500. So 57%, 22, 15, 20, 36, 27, and whatever that was, I'll measure it. I didn't populate the chart. But again, zero whipsaws, just showing you that all those periods where the histogram was red were associated with negative returns. Again, not, decent corrections, well into the double digits. And the one that I haven't updated in a while, I will do right now. What you do is turn this off, just grab a peek. We'll just grab right here. Monthly chart, so in less than 3 months, because those are monthly candles. Remember, this one, you hit bottom mid-month there, and whatever that was, the April candle, and then reversed. But high to low, that was a 21.5% drop. So we're talking about almost close to 22% right there. And that one's still positive, but again, so let's see what happens. Now, we go back here. SPY is in its own comparable trading range, but the S&P 500's held up better because of the financials, as I've talked about. But I'll get to that one second. More recently, we had some of the early sell signals I was looking for, are what I call check marks for the bearish case. And we're coming up into that midpoint range. There's my midpoint line. If you're new to the site, again, when I find trading ranges, whether they're sideways or whether you have a price channel, could be upward or downward sloping. It's not exactly always in the midpoint. Sometimes it's right about there, but usually roughly in the midpoint of the range. It's just pattern. I recognize that it tends to act as support and resistance within the larger range. Support, 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 support. So when this breaks, it increases the odds you're going to go back to the bottom of the range, and then ultimately a breakdown below that range will, what I call, seal the deal. For a kind of an all-in swing trend moment, short moment in the stock market. Again, your index of preference, mine being QQQ, unless I can make a pretty good case that the financials are going to fall as much, if not more, than tech. Because remember, that's one of the biggest difference. Besides, there's 500 stocks in the S&P and 100 in the NASDAQ 100. So you do have more diversity. You have a lot more sector diversification, and you have financials. It's the second largest sector in the S&P 500, and there's hardly any, virtually no representation of financials in the NASDAQ. It's mostly tech and biotech and things of that nature, high growth companies. So there it is, guys. So let's move on. See what happens there. And unless we break from these ranges, we will one way or another, sooner than later. It remains a stock picker's market. We've seen just mass sector rotation like I haven't seen in years, and it's healthy. It's great. It's a stock picker's market. This is where swing trading and individual security and sector selection shines, because those in the S&P 500, their 401ks, their IRA money has gone absolutely nowhere now for months. Gone up a little, down a little, and back to where it was all the way back in beginning of October right here. And remember, tech investors that are which are a lot of folks nowadays, especially where we're at with with the market being so strong and AI being everybody's favorite trade right now, those investors are faring even worse than the steady Eddie S&P 500 investors. Let's not forget the small caps. I did give you, that's also like that one as well. Gave you a short trade idea on it recently. It's still in play. We shorted it right here on January 16th. Made a slightly higher marginal new high, not well within any reasonable stop parameter to the final target. but when drawdown was virtually nil. It was a total drawdown of about 1.7% versus a price target of about 7.5. We hit my first target and we bounce. We hit my second target almost perfectly and bounce. And so these targets, if T1 was, which it was, support level back here when we first shorted it, the fact we had that reaction right here and the bounce, and then on several other occasions, including right here, helps to further validate that as significant, and now to more people a visible support level. It's a level I saw back here, and the fact we've had more reactions. Again, the more reactions, just the more eyes see it and the more obvious it is to everybody, and therefore you're going to have more buyers step in on pullbacks to it, and those same buyers, depending on their trading style and where their stops, you're going to have stops just below there. And likewise, short sellers see that level now, or should, and so when it breaks, it should take it down there. Now we've already checked it several times, so at this point, any of these reactions, it's already been taken out before. I wouldn't expect much of any reactions off it anymore. It's possible, again, until it's broken. There's a little downtrend line to watch too, guys, if you're looking for something that might be a catalyst to pop us back up, or objective short entries. So basically, keep it simple right here. You're at a downtrend line. That's an objective short entry right now. And the next objective short entry. And again, this goes in reverse for bulls. Buy points would be a breakout of the downtrend line. And whereas the next objective short entry after right here would come on a break of 258.78. That's also support. So those bullish, thinking the market's going to go to new highs, can buy there with a stop somewhat below. Whereas my preference is to wait for a break of that. And then that should take us down. Remember, T2's already been hit, so it's already been checked. Doesn't mean we can't have another reaction. It just increases the odds that we may go on through there with little, if any, reaction this time around to my next target, T3 and then T4. And remember, this is just a 60-minute chart. Those are short-term targets. When I go to the weekly or the daily chart, I've given you longer-term typical swing targets. T1's already hit right here. Need to just mark that as such. Covered that probably in previous videos. And then T2, 3, 4 down here. You have the 200 days. And then if those are hit, I'll probably turn my focus back to the weekly chart, just like on QQQ and SPY. These are still my longer term targets where I think we're going either sometime this year or within the next couple years. Down here, it's going to be a drop of, if that happens, minimum long-term target is going to be a drop of about 60% in the small caps. My maximum long-term target range zone is about a 65 down to about a 67, almost 68% drop from the recent highs, which were just off. That's DH, divergent high. Oh, also very much, and see, this is why, I start on those shorter term charts, the 60-minute, the daily, and then work my way out. I trade multiple time frames. I analyze on multiple time frames. So it's that if A plus B equals C, that kind of thing. So basically, or if this, then that. So this 245.35, we had a 1, 2, 3 triple top, and we broke out, right? So glass half full, being an optimist, that is bullish. And right now it is. Again, we're short. We're short based on the 60-minute chart and the daily chart, those sell signals. But longer term, very powerful if we fall back below there, because this whole thing then becomes a failed breakout. And if you followed me for a while, you've heard me say this many times. There are fewer things in trading more bearish than a failed breakout. Because what happens is a lot of traders will buy that new all-time high in the small caps because everybody's profitable at that point in time. You have no remorseful sellers. So on face value, breakouts to new all-time highs are bullish. However, it's everything else I look at in the charts that tell me it's a breakout that's likely to fail. When it does, that's pretty powerful, because then all the Johnny-come-lately longs that we're buying small caps here, not here or here or here when we were buying and covering, we shorted it down, we had 3 targets. Those that are buying now will realize they're long, they're wrong, they're going to go underwater, and their stops Well, again, everybody's got stops at different point. They start to get hit. That creates more selling. And then the sharks that smell blood in the water, i.e. the short sellers, they start jumping in too and joining the party. And that's why stocks almost always fall a lot faster than they rise. So that's my, and then you can see I just added this trend line right here. Let's set a nice price alert. Let's color it up. That's probably the one of the most important trend lines to watch right now in the IWM. I probably have it on the daily. It comes off the recent lows right here, back from last what's that, last April lows. All right, so set a price alert so we know when that triggers. You have the negative divergence still intact. That's it. All right, let's move on to a few more things. Let me jump into Bitcoin. Yeah, and I always encourage everyone to check the comment section. Come in if you're, depending on your level of activity. A lot of the little tidbits I'll add in either something on my own or a reply to a question or comment from someone else. So Mike, happy about these two trades. But I gave my thoughts here, and I've been giving those, and I want to give it again today, is that I am leaning more and more to that. As I said last week, I sold most of my MSTR when the first target zone was hit, bottom of that zone. And then Friday, I unloaded the rest. I didn't want to take it into the weekend. And this has been increasingly, and it is my preferred scenario, that the bounce that we gained in Bitcoin and in MSTR, that was huge, biggest one-day gain probably that stock's ever had or close to it, is most likely just a reflexive oversold bounce. And I'm going to show you why. And again, I've been covering this quite a bit lately. This is my Bitcoin, the actual crypto, BTC, trades on the Paxos exchange right there. You had a divergent high, you had a sell signal. These are your trends. I've covered this many times. Bear trend ended with a bullish falling wedge. That was a bearish rising wedge, sell signal. Big correction there. All these corrections, you guys know, on Bitcoin, the trends are usually 50 to 80%. They're big. Or on the correction side, and on the upside, even well over 100%. Divergent low, bullish, started a new uptrend. So we had multiple sell signals. Sell signal 1 on the trend line break there. Then the primary, even more significant trend line broke, bounced around, support. And most recently, we took out that 73,500 level and added this line here because now I recognize that recent low as a reaction low, and there was minor support there. That's the only update I've done to the chart since I've been covering this thing for months now with you. All these other levels have been there, and as I said, it was a hell of a bounce. It doesn't look like a lot here, but nice bounce in Bitcoin. We nailed the entry on that MSTR. You literally couldn't have gotten in better, but after hours entry. And but that's it. So Bitcoin, remember, shot through. This was a big support level. I tried to catch a long bounce there, and it didn't work out. That was taken right through. And then support, once broken, becomes resistance. And so we rallied back to it, and we're below it. And that increases the odds, and we're going to hit my next. I've always maintained this is the final target from this divergent high here. The wedge break is at 48,671. I was only looking for a counter trend bounce. I thought it might get a little more legs, go up to here, possibly even there. But at this point, and it still could, guys, it could, but I don't see it in the charts. We were extremely oversold. That's why we went long Bitcoin, or strategy recently. Strategy did better than Bitcoin, because remember, strategy is simply a leveraged play on it. The way it works. And that's it. So I don't see a lot of evidence in the chart of a bottom, just a tradable bottom, not a bottom end of a trend. Now again, if it can take that level out, then yeah, it may easily have some more upside, and then do that later. I'll still maintain that target whether we bounce more or not. However, at this point in time, again, as I said in that comment last week, I'm leaning towards the fact that bounce may be over, and we may go down here. And that's going to be, try to measure it for you. I have to do it this way, or I move all my lines. I have to make a line. I'll make it a little longer from that recent bounce. That's a little too long. About a 30, we'll call it about a 30% drop from the recent bounce. We might be a little under that high. So that's it, guys. So let me go to strategy. MSTR. Look, we're still, we entered right there. I think what was that our entry 102.19. Yeah, and then after we had the big move up, so, in the video I said raise stop to entry. Stop was raised to entry, and it's still very much up. We're hardly off that bottom of that revised T1 zone. Remember, I've revised this twice, and so that's it. And look, this is maybe a little healthy consolidation. I can tell you, if we can punch up here, and it's going to take Bitcoin going up to do so, but you have, the target zone is two resistance levels in close proximity, horizontal resistance levels, plus you have the downtrend line. So that's a confluence of resistance, and it'll be quite bullish. And if it's taken out, yeah, then we probably will go up to that T2 and T3 I gave you. And I may jump back into the trade. But like I said, positive divergence, a lot to like on this chart. When I look at Bitcoin and the main Bitcoin ETF, there's quite a bit out there, but IBIT is considered the most liquid. We had some divergence. It's pretty much been taken out. You can see we have lower lows now there. So the divergence has been negated by, the indicators making lower lows along with price. So I'm going to take that divergence line away and just say that it's going to increase the odds we come down to that 3140-ish target right there. It's sloppy, but that might be a bearish pennant. You can look that pattern up. It's the close cousin of a bear flag continuation pattern. You have three components: an impulsive move down known as the flagpole. A bear flag would be in this form, and a bearish pennant is in this form, kind of like a triangle. But the same net effect. A breakdown below there would actually, the measured target is the length of the flagpole added to the top of the pennant before it breaks down. That would actually overshoot that 3141 target. Either way, it's been a big move. It's digesting the gain, just like silver. Remember I told you that? Silver and gold, it's going to take, we nailed that big drop. But when you have that big drop, and as I already had showed you previously on the long-term charts, it takes a while. Here, let me cue that up. Let's move into that one now. Oh, before I do, when I clicked this other tab, I had another window open. I was already in my stock charts account. I wanted to share this one with the market. This is my if you follow me for a while, I've shared this one over many times over the years. It's what I call my custom NASDAQ Hindenburg indicator. Nobody talks about the Hindenburg anymore. I never hear anything about it. It was popular back in the 90s and in the early 2000s. Somebody came up with it's a market crash indicator. And, we've been in with this 2 decades now of super easy money and stimulus, and the Fed coming in aggressively at every single correction. They've just pretty much have a mantra now of prohibiting corrections and recessions and bear markets, which I use the analogy of prescribed burns in the forest. Here in Florida, I know you guys do it out west, California, especially the dry areas out there. Prescribed burns, the forestry department comes in and burns down the underbrush, so it doesn't create that huge 100-year fire that takes down the giant redwoods and everything, or at least here in Florida, all our pines and oaks and things like that, because we have a dry season, especially down here in Southwest Florida, and we get fire. So it's the same premise. A recession and corrections and bear markets are natural parts of the business cycle. They always have been. And what the Fed keeps doing, what they've done is they've created, I believe, a degree of recklessness that is unprecedented, and that's where that plays into my long-term outlook. And again, it was easy to do. Every time the market hiccups, bring rates back to zero, do more quantitative easing, and that worked great since the financial crisis, until a couple years ago when inflation finally started to rear its ugly head, and the bond vigilantes started to say, no more easy money. And we've seen that. I've talked about it ad nauseum. The last current Fed cutting cycle and the one that they did a year earlier, 3 back-to-back rate cuts, same thing. Long-term rates, instead of going down, went up. So the Fed, it's widely known now, has lost control along end of the curve. And you have Trump trying to jawbone the Fed to cut short-term rates. and I guess he's so arrogant, his advisors, he won't listen to anybody. If you don't, if he doesn't like what you say to him, you get fired. But, all somebody has to do is show him, hey, look, it's not working anymore. You're going to cut short-term rates. You're helping the banks, but you're hurting the consumer because the 10-year treasury yields and 30-year mortgages, rates that consumers borrow at are going up each time you do that. So there's the rub. My point is that I think the days of the Fed coming to the rescue, that Fed put, which is so ingrained in the psyche of not just the U.S. investor, all global investors. It is so powerful, and I think it's going to be a massive blow of confidence in the market when they realize that the Fed won't be able to continue to come to the rescue, at least not to the extent they have in the past. All right, enough on that. So what I wanted to show you, so on this indicator, basically the original Hindenburg indicator uses the NYSE, and years ago, it was very apparent to me that tech was everything. And again, you just look at the top 10 largest companies in the world. They're all tech. They're all the Alphabets, Amazons. There's not a banks are dwarfed. As big as J.P. Morgan is, that's the largest bank. It's dwarfed by NVIDIA and Microsoft and Amazon and Alphabet. So these are the companies that matter and have for currently and have for years. So that's why I changed, and I just flipped all the criteria using the same criteria that the original Hindenburg, except using it with the NASDAQ McClellan oscillator, the NASDAQ new highs to new lows, and all that stuff. So what I wanted to mention is I've been following this thing for decades since I created it. I created it back in the mid 2000s. I think it was even before the financial crisis or right after that. And I've never seen such a tight cluster. The one little caveat I'll give you, one of the criteria to show you, but I don't know if you can see these lines before I move on because I'm zoomed in. These are 1, 2, 3, 4, 5, 6, 7, and then 1, 2, 3 more consecutive days. And that's what in the original indicator, it's not a one-time thing. You get one signal and the market's going to crash. No, they tell you want to look for clusters. And the one little thing is that the NASDAQ is supposed to be, or at least on the original one, the NYSE was supposed to be trading at or above where it was 50 days earlier, or you can put in the 50-day moving average. And so we're a little bit below that. So I'm going to say that kind of, but again, it's a little bit unusual because the market has been, as I started the video, in this sideways trading range, and it's not far below. So for all intents and purposes, it's the market's gone nowhere for a while. So technically, like I said, if you want to take it literal, and again, I won't spend much more time on it. We'll see if we get a big crash coming up. We're going to say, I'm letting you know it's firing signals like I've never seen before. And again, it's a breadth-based indicator. It shows very unusual things under the hood, and a lot of stocks doing poorly at the same time, a lot doing well. And again, we've been just absolutely slaying that, when you go to the trade ideas, completed trades for months and quarters now, and you go back through, and we've been stopped out on a few lately, but I just going from memory, I have to say it's probably 80 to if not 90% success rate on the trade ideas, and they're just everywhere. Ship Finance, Molina Health, and Mondelez and Netflix, and that one stopped out. Treasury bonds. Just boom, 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 boom. And again, that's, like I said, it's been a stock picker's market, but that one indicator I just showed you tells you something is wonky right now, very unusual. You don't get these indicators, these signals firing often. And again, if you want to know what they are, I go back to, I just have to go out a little farther, go back 6 years here. And there's a criteria. You can stop the video and just take a screenshot to see what needs to occur on all the same day. That's 1, 2, 3, 4, 5 conditions have to occur. And like I said, the NASDAQ's flattened out, so it's not literally, you have to give it a little room on this one right now. Okay, I'm just going to start with this chart. This one I shared with you right before silver crashed. It's the gold to silver ratio. We've got a weekly chart. We're going all the way back, taking it back to the mid 80s. So I think Madonna, Reagan, whatever was going on back then. And showed you there's a zone that I've marked. These three lines that typically it's the ratio. When silver is doing better than gold, outperforming, this ratio is falling. I mean, it's the gold to silver ratio. So when this is going up, gold's doing better. And so we hit right about in the middle of that range in reverse. And as I've said, typically once you see a clear reversal, again, the bottom can come anywhere in this range from here down to here with that one spike extreme. And so we hit the middle of it. And the takeaway was what I did for you before. Again, this is a recap for those that already saw this, as well as folks that haven't. Let me go to the very bottom. Let me do that a little bit more. Okay, so when the ratio has troughed and clearly reversed, that's these dotted lines you can see coming down here. 1, 2, 3. I measured the performance of silver going forward. I'm going to read it out to you in case you can't see these little. I can't make it any bigger, I don't think, in that thing. That's 64% bear market. You can see that's from 1987 all the way to 93. So silver had a great run up, and that was the end of the road. 38% drop off this peak right there, and a 31% off that, or that trough, I should say, in the ratio. 31. This trough was followed by a 34% drop. Then you had another one here followed by a 56% drop. That extreme right there was followed by a multi-year, about nearly a decade-long bear market. Before all said and done, silver fell by 74%. So that reiterate my case that silver has likely peaked. It's not just a correction that we're seeing right now. And then the next chart. And this is the one that, to me, made the crash about a near certainty. I was sharing it over and over. Silver every so often. We're going back in again to the mid-90s here. It's a 30-something year chart. And every now and then, silver likes to go parabolic. And as I often say, parabolic advances rarely end well. And that's a bit of an understatement. 49, about a 50% bear market, parabolic advance into the top, 60% drop, parabolic advance, 78% drop, parabolic advance right here, 41% drop, and a big parabolic advance comparable to these here. And so those are still my longer term targets. My maximum target, I'm calling for a 71% drop from the peak in silver. And so that's that. Now, as I did in the previous videos right before silver crashed, I showed you that after the parabolic line's taken out, silver consolidates for a while and typically retraces about half or so of the drop. There's always that initial. The dip buyers, remember, are like Pavlov's dogs. They're conditioned. After a strong parabolic advance, everybody is foaming at the mouth bullish, and they want in on silver because they were missing it, and then they were, they didn't want to buy it here and here and here when it's a good time to buy. They wanted to buy here, but it was going up so much, and so they were waiting, or they did. They got a little taste of it, and they want more. So bottom line is, you get those bounces, and then the bear market's going to resume. It's a little too early to tell now if the initial. Typically, it's usually a few months of slop and chop, right? You can see if you have to zoom in on this chart. And I encourage you to do it. Pull a long-term chart of silver and look what happened after these parabolic trendline breaks. But bottom line, it's not impossible, but it would be extremely atypical to, see it resume with just a little pullback and then a continuation. I've never seen it. When a parabolic trend breaks, I've never seen a second parabolic advance go, or even a steady, natural kind of more normal bull market. Maybe it happens. This will be the first time, or at least the first time that I've seen it. So again, that speaks, in my opinion, to the longer term outlook of silver. Now, the only thing giving me maybe a little bit of pause or kind of tempering my the longer term bearishness is gold. Gold also has gone parabolic. It doesn't, not on this chart. I'm on a weekly time frame. You can see it better. I'll go to a monthly. But here's a trend line I want to see taken out on gold. This trend line comes off the August of last year lows. And so once that goes, I think that'll help make a case, because silver's only going to drop so far without gold. Now, the ratio may kick in. This is where, again, you put a gun to my head and said, Randy, you got to be long silver or gold, which is it going to be for the next, year, 5 years, 3 years? I would say gold at this point. Usually I trade silver because it's a lever. It just moves up and down more. But this is gold on a monthly chart. Let me park the PPO histogram. And again, I don't have the log trend line, parabolic trend line. I can't draw here, but I can hand draw it in for you. You can see how it's gone parabolic. So when you have a parabolic advance, really what I'll do on the charting platforms that only give you straight trend lines, it's just a series of linear trend lines with increasing slopes. I mean, that's the definition of a parabolic advance anyway. So an increasing slope on the trend line, which gives you that curved look. All right, and now let me loop back. I probably should have done it with the equity markets. I'm just going to finish up with financials. It's a busy chart, but again, I've been stating for a long time that the market, even the NASDAQ 100, which has been weak, would only go down so far without the financials breaking, because they are the second largest. You have 12 sectors in the S&P 500. The largest is by far the tech, which is about a 34% weighting, over a third. That's as of last time I updated it, September last year. And that is going to mirror the NASDAQ 100. So you have the same thing. You have a trading range. The level on XLK, the tech sector ETF, is about 134.45. And you have those beautiful 200-day moving averages. They just came in and bottom there when they were hit the bottom of the trading range. So that's the lights out level. When that breaks, tech's going to start to waterfall down. And then they'll most likely bring the financials down with it. And as I've covered recently, financials broke out to new highs, but that breakout right here above 54.50 failed. That was my first check mark. Then I wanted to see this 53.10 level go. That failed. I wanted to see the 200s go. That failed. And then this remains my what I call lights out level, 51.08 or 51. Let's round off. And we pretty much hit it. Probably hit it exactly in pre-market. I don't know that day. That would have been Friday. And we're bouncing. But what this is, we lost the 200s. We're back testing from below right now. Bulls want to see that recovered. The clear move above the 200s. Also recovery, of course, back above 54.50, but really above the previous highs. And if this happens, well, you're going to be looking at a stock market that's got some more legs in it right now. It's not what I think is going to happen, but again, react. You can predict, you can expect, you can have a plan, but unless 51 goes, the market's only going to go so low. Again, it's that simple mathematical weighting with the financials being about 14%. And that's it. So discretionary, I'm just going to go over the other sectors. That already broke down, put it into divergent high, broke its trend line. Currently testing its 200-day moving averages, both the simple and exponential. Also testing about the 114 support. So this is a big level. You want to see that level go. If it does, that's your next stop, about 109 or so. It's going to be from where we're at right now. If that happens, about another 5% drop. I could and will certainly give you additional targets there. There'll be more, but just wanted to point out, just like that divergent high, sell signal, bear market ensued, ended with a divergent low. This is a big divergent high. Again, to me, looks like the market's topped. I'm just waiting for the next sell signals to, make objective add-ons or new entries for those of you looking for short entries. And again, those of you bullish, buy. You buy pullbacks. It's simple. It's the most simple strategy out there. Buy pullbacks to the 200-day moving averages in a bull market, and you're going to be happy. And then you sell when things get, and you get some sell signals. Things get a little too overbought. You get too far away from the 200 days. But again, I would tell you if I was buying here, but I'm not waiting to see that go. And I think it will. And when it does, it's just another check mark for the bearish case. That's all. So that's XLY. That is the third largest sector in the S&P at about 11% weighting. Communication sector is the fourth largest, about 11%, also 10.5 last time I checked. And this was that prediction back then. I gave it a check mark today. Any new high will be another divergent high. That's what that little acronym, I covered that in a video when we were back here somewhere. And that's what happened. We made a marginal and still divergent high. It seems to be the MO for this market. That breakout to all-time highs failed. And, it's not the end of the world unless you take out the 200s. Then we'll get the party started. And again, it looks like it when I look. It's a big divergent high. But just kind of showing you the makeup of the entire market. As I always say, an index is simply a sum of its parts. And with the S&P 500, you have those 11 parts, those 11 key sectors. Tech, financials, consumer discretionary, communications, healthcare, industrials, staples, energy, and utilities. I'll get to the rest of those in a second here. So there's XLC. XLV healthcare also just put in a divergent high recently, then broke down the uptrend line. It's also a bearish rising wedge pattern right there. There's your divergence line. There's your uptrend line. Just like you had an uptrend line there, divergent high. And that's that. Now you're still on this trend indicator, still bullish. The zero line delineates bull and bear trends quite often. So if this crosses below, that's going to further increase the odds like it did right here. You had all that to come. Right there you crossed down. You had all that to come. And here you made a cross, right? Wasn't a lot left, but so that's healthcare, industrials, big divergence forming. No sell signals yet. We need this sector to buckle. But again, now we're talking at 8% weighting. So, these are big companies, Caterpillar, GE, Raytheon, Boeing, Deere. And they will have an impact on the S&P, but not nearly what tech and financials. That's why I'm doing it this way. XLP, staples. Okay, few weeks back, I got bullish. Said it was the best looking sector, but it just ripped. They went way too far ahead of themselves. You can probably short them now, take profits if you're in it. We're going to look at a correction, and now we have a bearish engulfing candle forming today, which wipes out. If it finalizes, it's going to wipe out the previous two candles, and that's a potential reversal stick. PPO is buried in nosebleed territory, as is the RSI. So I wouldn't buy staples right now with your money. If anything, short it for a pullback, get in later. And this, as I also told you, was a front-running trade. Really, it's institutional money seeing what's coming in the stock market, knowing with a pretty good degree of confidence, and they've been flooding into staples because this is a defensive sector. And so that is not bullish, if you will, for the longer term outlook of the market. It's more bearish, showing you where the smart money's moving their money into right now. Only 5% weightings. It's not going to move the needle that much. Energy also nosebleed territory. PPO is about to make a bearish, high-level bearish crossover, meaning it's up here. It rarely gets to that level. When it does, that's usually about the end of the run, at least for a while before a correction coming. So this is another sector you could either book profits on, tighten up stops, or outright short for a pullback trade. I'll have to, hone in on the 60-minute chart. There's a little price channel. So a break below that price channel is going to take you down. If you're interested, I'll give you targets. I haven't really come up with any yet. I would tell you it's probably going to pull back to these previous highs right about there, $49. So that's going to be a drop from the recent high. If we come back in there, about 11% drop. Utilities, also a big defensive sector. You don't stop paying your electric bill when times get tough. So this is also where institutions move when they think the economy is slowing down. They'll move into the steady Eddie utility stocks. They also pay a dividend and all that, and they've just exploded since taking that level out. Don't know if I wouldn't chase the move now. I'm just kind of giving you a broad. Again, the point of this was to cover the 11 sectors to show you what it looks like. And I can't find one right now that I'm excited about. And we've been doing that. We've been, sector rotation. Remember, consumer staples, couple months ago, I was very excited. Actually, it was the best looking one out there. Now there's really not a lot looking good. So I think this, I think we're getting to close to that point where this trading range is ready to break, and I'm going to leave it there. Just again, only guarantee I'm ever going to give you is that I'll be wrong, and I'll be wrong a lot. But I would say if you agree with that analysis, just be ready to move. It's probably going to happen quick if and when that breaks. I think we can move down to T2 in a day or two, possibly. No more than a week once that level breaks, probably less than a week. And that'd be a drop. It's not much, but it's about a 6% drop. It could happen pretty fast. And that's not to say there can't be more. You go to the long-term weekly chart. I have, deeper targets. These are still my targets on the weekly chart. And you can see it here. This is the bottom of the trading range. This is the whole trading range. And once that breaks, you're also going to take out the 200-day moving averages. So it should be a quick ride down to T1. They'll probably come in and buy it there, would be my guess. Tradable bounce, then T2, and then the deeper targets. I may change that to T3. I'll just leave them as they've been. All right, guys, I'm going to wrap the video up here. If I missed anything, I'll either cover it in the comment section below this video or in a new post. This has been Randy Finney with Right Side of the Chart. Have a great day.